After I shared this post in my Sunday video about stocks that I believe could return 15%, a lot of you in the comments seemed extremely interested in stocks that could return 15% per year for the next 5 to 10 years. And I'm sharing two stocks that I haven't talked about much that I believe could return 15%, two different stocks than the ones that I talked about on Twitter, because some of these stocks have already started to play out since I talked about them. Google, which people said it's dead, it's up around 7.5% since this post. Same thing with Pepsi. People told me Pepsi is overvalued. Why would you buy Pepsi? Made fun of me in the comments. Well, Pepsi so far is up 4% on Monday because it got upgraded to 190, which is another 15% on the upside from here. I mean, I bought this stock on Friday and now I'm up 4% on Monday, and it's been doing well so far. So I'm going to share two new stocks here in the video. This is not financial advice. Maybe they don't end up returning 15%, but I'm going to tell you my thesis on why I believe they will most likely be returning 15% for the next 5 to 10 years. The first stock, I've talked about it only once, and I'm going to do an update on it, very quick update. I keep my videos short. And this is a company called ATD Alimentation, a very popular stock in Canada. They have a Canadian listing. They have an OTC listing for the United States. I also believe it's available on Robinhood and Webull because it's a pretty popular one. Sometimes they have OTC listings over there. And they also have a French listing and a German listing, I think, and all over. So it's a very popular company. You might have never heard of it, but this is one of the best performers of all time, up more than 17,000% for a very boring business models. And they mainly own convenience stores and gas stations. You may have seen Circle K gas stations, convenience stores in the United States. This is a brand owned by Alimentation. They have like 26 other brands, I think, but the most popular one is Circle K. Over 14,425 convenience stores. Very boring business model, yet this company is up 17,000% over the last 5 years. It's up 121%. And over the last year alone, it's up pretty close to 29%. And this is what I try to tell you guys, that you don't always have to look for the next big thing. You don't always have to find the next Tesla, the next Nvidia. You have a lot of stocks that are under the radar, returning 15, 20, 25% annual for decades, and they will continue doing so. And these are my favorite business models, and I own a lot of them in my own portfolio. But in terms of the company itself, most of the gross profits is, of course, made by fuel. 50% is made by fuel. 49% is made by merchandising and services. As you know, and if you know anyone that owns a gas station, they don't make massive profits in the United States. Most of the money is made inside the convenience stores where people buy stuff. So 49% is in merchandise. 1% is in others. I know a lot of you maybe are concerned about the whole EV revolution, that because EVs are the future and we're going to have more EVs, that means these convenience stores and gas stations are going to go out of business and they're going to be closed. Well, this is not really true. First, it's going to take a very long time for this to happen, especially in the United States, not over the next 5 to 10 years, that's for sure. But the second thing is the company is doing a lot of things in Norway and mainly in Europe in general around putting EV stations within the gas stations. So they have a gas station over here, and on the sides they have EV charging stations. And what they noticed was that it actually made the whole business model even more profitable. It got more traffic to the store. And because you have to wait a little bit longer for your EV to charge, you're likely going to consume something. Maybe go to the convenience store, buy some chips, buy some Coke or Pepsi or water or whatever you buy, and then maybe you consume something while you wait for your EV to charge. So they ended up making more money whenever they put the EV chargers. It was a pretty amazing experiment, and they're rolling it more and more into Europe. So yes, of course, EVs are going to eventually affect the business model somehow in the very far future, but it's not going to completely kill the business model because they're doing something about it, and they're doing a lot of things within EV charging stations. Pretty amazing. Now, the company is trading around 18.5 times free cash flow, market cap to free cash flow, 18.5 times. The mean was 18.6. I don't think this is expensive at all, but I also don't believe it's cheap. I think the company is fairly valued, and it's been fairly valued for a long time. It's very hard to get a bargain on the stock unless you bought it maybe in March 2020 or something like that. It's very hard to get a bargain. You most likely have to buy a high quality company at a fair value, like Warren Buffett says, they do pay a small dividend. It's like even less than 1%, but they mainly do buybacks, 2 or 3% of the market cap, sometimes 4% of the market cap. So they've been doing a lot of buybacks lately, especially whenever the stock gets cheap. Free cash flow yield is trading at a 5.4% free cash flow yield versus a mean of 5.7 times. So I believe we're paying a fair value for ATD. And the way I see the company returning 15% is the same way they returned 15% in the past. They take the free cash flow, they do a little bit of dividends, they do a little bit of buybacks, and they do a lot of acquisitions. They acquire car washes, they acquire Total in Europe. They acquired many different assets around the world, different convenience stores, car washes, things to expand the business model, and they target 15% return on capital employed. Now, they were able to get 17.5% over the last year in terms of return on capital employed. And as Charlie Munger said, over the very long term, the return of the stock is going to be pretty close to the return on capital. So if the return on capital for ATD ended up being around 15% for the future like it's been, I see a minimum of a 15% annual return if we don't experience a multiple contraction, which means we have to be paying a fair price. And for the stock sitting at 18.5 times free cash flow with a mean of 18.6, I personally believe we are paying a fair price on ATD. Now here's the trick. The stock is reporting earnings very, very soon. I think it's tomorrow or the day after. You could check it out. And it's getting pretty close to the trend line. So it's around a 2.6% decline. The stock was down 3% on Monday whenever I'm filming this video. So if I had to buy the stock, I would see if it holds 78 and then I would open a small position. Dollar cost average down if it ever gets to $73, $74. But this is the company. It's been on a massive, massive uptrend for, pretty much forever. And this is a pretty nice looking chart. You're not buying like a massive fear situation or anything like I normally do. This is more of a high quality company trading at fair value that I believe could return 15%. It has done it in the past. It has exceeded 15%. And I think it will easily be able to return 15% for the future. Now, the second one, which is not really riskier, it's also not a small company. It's a mid to large cap company, as you could say. And a lot of you are going to be familiar with the second one. And this is a REIT called ADC, which is Agree Realty Corporation. I really, really like this REIT. I've been watching it every day, and I should have bought some. I don't know why I haven't done it yet. Maybe because I own another one. But ADC is sitting at $56 per share. It's sitting at the same price it was sitting at in 2019. I'm bullish on REITs, but ADC is a little bit different because the company is smaller. It's going to be much easier for them to grow in terms of acquisitions than something like Realty Income. I think the whole market cap is like $5.5 billion. In terms of the tenants, 6.1% is Walmart. Pretty safe stuff. 5.1% is Tractor Supply, not my favorite. It's not bad. 4.8% is Dollar General. 3.5% is Best Buy, not the best. 3.1% you have CVS, TJ Maxx. You have Dollar General, Dollar Tree, Kroger, O'Reilly, which I like very, very much, Lowe's, 7-Eleven, Sunbelt Rentals, which I really like, Wawa, Home Depot, BJ's, Sherwin-Williams, pretty amazing tenants. Some of them are risky, maybe 5 or 6%, but most of it is within grocery stores, within convenience stores, within many things around pharmacies and auto repair and tires. So I really like the tenant profile of the company. I'm happy that Dollar General is not their largest tenant. I always freak out whenever I see Dollar General is the top one because they've been closing a lot of stores. I go and I look for triple nets to buy for my own personal portfolio, and then I see everyone is dumping Dollar General, Dollar Tree. They're for sale everywhere at 6 and 6.5% cap rates. These institutional investors are dumping Dollar General triple nets for good reasons. And I haven't bought one. I've just been looking around, and this is what I've been seeing. I normally try to stay away whenever I see something like that. In terms of the dividend, it's paid monthly, just like Realty Income every single month. They grow it around 6% CAGR for the last 10 years. They grow the dividend fast. The balance sheet, they call it a fortress balance sheet. It's not really a fortress, but it's not bad at all. And there's no major maturities before 2028, which is more than enough for me whenever I'm calculating a 15% annual return for the next 5 years minimum. Now, they have a 5.15% dividend yield for the stock, so around 5%, around 3.7 to 3.8 adjusted funds from operation per share growth. This is what's expected, even though the company was able to grow 6 to 7%. But we have much higher interest rates, it's going to be a little bit harder. So the analysts are pricing in high 3%, pretty close to 4%. We can round it up to 4% and a 5% dividend. This is a 9% annual return on ADC. Around 5% from the dividend, 4% AFFO per share growth. You're getting a 9% annual return from the company. Then you have the potential multiple expansion, which I believe is an easy money. I think most REITs are honestly easy money stocks. And if I had a lot of cash, which I don't because I'm pretty much 100% invested in more short-term stuff and some long-term positions. But if I was 100% cash and I was looking for an easy money setup, I would be buying REITs like never before. To me, it's an easiest money ever in the market. And it's sitting at 13.8 times adjusted from operations per share. It traded as high as 24 times whenever we had 0% interest rates or interest rates were being cut. Now, I'm not saying we're going to go back to 24 and 25 times AFFO per share, but I could easily see ADC coming back to 17.5 times AFFO over the next 5 years after interest rates come down a little bit. Maybe they're not going to come down this year, but they're eventually going to come down over the next 5 years. We're likely going to get to 2.5 or 3%, somewhere close to the neutral rate. Powell said around 2.25 to 2.5. So if we do get there, I don't see why ADC is not going to be trading at 17.5 times AFFO per share. So if we look at it and we look at the around 4% AFFO per share growth, we get around 469 of adjusted funds from operation by 2028. Now we take the 469 and we time it by the mean AFFO per share multiple, which was around 17.6. We time it by 17.6, we get 82.50 for the stock in terms of the share price. We divide it by the current share price, which is around $56 per share. I'm getting 47% on the upside over the next 5 years in terms of price appreciation. But remember, we have 47.5% on the upside, but we also have the 9% annual because we have the 4% AFFO per share growth every single year in terms of value. And then we have the 5% dividend, which is 9%. And we times the 9% by 5 years, we get 45%, and we add in the 47%. This is pretty close to 92% on the upside over the next 5 years for ADC, pretty close to 100%. So this is like around the 14% category. Maybe I lied and I cheated a little bit. I said 15%, but it's around 14% for ADC, and I would not be surprised if it's a little bit higher. This is why I always say REITs are easy money, but you have to have a lot of patience because you don't know when it's going to play out. You don't know when the Fed's going to cut interest rates. But even if they don't in the meantime, you're getting a 5 or 6% dividend. You're getting a company that's growing and acquiring assets at a very high cap rates for the environment. And once rates come down, cap rates are going to come lower, which is going to increase the value of the assets that they are purchasing right now. And this is the key things with these two stocks, but mainly REITs. You need a lot of patience. Now, this were my thoughts on ADC and ATD. I hope you enjoyed the video. It was not financial advice. Thank you for watching it again. And if you enjoyed it, please press the like button and maybe consider subscribing. So I hope to see you in another video.